Hello and good morning everyone. I am Sundaranjan Sao, Assistant Professor of Department of Commerce, Odisha State Open University. Now, I am going to discuss about the taxable income of companies, which is comes under your Unit 6 course PCO 104 Corporate Taxation. So, let's start this videos or session without wasting any time. So, first one is learning outcome of this unit. By the end of this unit, you should be able to clearly define taxable income in context of companies, then distinguish between allowable and non-allowable deduction under Section Income Tax Act 1961, then understand the step-by-step process to compute the taxable income, then apply the basic tax accounting principle for accurate computation. So now I am going to discuss about the introduction part of taxable income. In simple terms, taxable income refers to the portion of company's income that is subject to tax after accounting for all permissible deductions. It is governed by Income Tax Act 1961 and forms the basis on which corporate tax is levied. This figure is crucial for two main reasons. One is to ensure compliance with tax laws, and another is for strategic tax planning. Then now I am coming to the sources of taxable income. As we have already discussed about in our previous session that there are four types of sources of taxable income. First one is operating profit, and the operating profit means the profit which arises from the day-to-day business operation. That is called operating profit. And another is income from house property. If any business run any house property and it will get rent from that house property, that is called income from house property. Then another sources of income is capital gain. Capital gain is the gain which is arises from the sale of any capital asset. It may be share or any property. Then another sources of income of a company is income from other source, that is interest, dividend, royalties, etc. Now, I am coming to the point of deductibility of expenses. Generally, there is allowed deduction, there is some item which are non-allowable or restricted deduction. So first one is allowable deduction. Depreciation is one of the allowable deduction. Permanently decrease in the value of fixed asset, that is known as depreciation. Then another item which is allowed for deduction, that is interest paid on business loan and borrowings. Then there is certain item which are non-allowable for deduction, that is entertainment expenses that are personal or excessive in nature. Then interest paid to non-resident. Then another is corporate tax already paid cannot be claimed previously, that is also non-allowable deduction. It is important to carefully to separate various items, which one is allowable deduction and which one is non-allowable deduction. Now, I am discuss about the steps or various process in which we will able to compute the taxable income. In our first step, we will aggregate all the sources of income, which is also called gross total income. And then in our second stage, we will set up any previous losses or claim all the deduction which are available from section 80C to 80U. Then we will compute the tax liability on the net income. So formula to calculate the taxable income is total income minus allowable deduction. But be aware, this is not always straightforward due to certain accounting consideration. There are three types of adjustment that can affect the computation of taxable income. First one is permanent differences. So these are expenses that are never allowed for tax purpose, such as penalties and fines. Then timing differences. Some item may be allowed in accounting books in 1 year, but for tax purpose in another year, like certain previous or deferred income. Then future timing differences. This gives rise to deferred tax asset or liabilities, depending on whether they create future deductibility or taxable amount. These principles are important for ensuring computation align with accounting standard and tax laws. Then there is one of the example of computation of taxable income. If a company earn operating profit 10 lakh and there is allowable deduction 2 lakhs, this allowable deduction may be include depreciation, interest, etc. So here the taxable income is 10 lakh minus 2 lakh is equal to 8 lakh, and at that time the tax rate assumed at 25%. Then the tax amount will be 25% of 8 lakh is equal to 2 lakh. So this is one of the simple example for computation of taxable income. Now I am coming to the importance of tax compliance and planning. The taxable income is very essential to avoid the legal penalties, and it also optimize the deduction as we are perfectly or calculate the tax liability according to the provision of Income Tax Act 1961. So we will also available that optimizer deduction as we are follows the basic rule of income tax. Then it also ensure smooth financial management. So the idea is not just compute tax liability correctly, but to plan for it efficiently. Now I am coming to the end point of this session, that is conclusion. Taxable income is a carefully calculated figure, not merely accounting profit. Only eligible deduction can be claimed under the law. Companies must understand the sources of income and how each is treated. Then accurate computation helps the reducing tax liability and ensuring compliance. Always keep in mind a well-informed tax strategy is key to sustainable and compliant business operation. That's all about the taxable income in a computation of taxable income, and thank you.